All right. Thank you for attending, everyone. This is a very impactful speaker, Brian Doherty here, hosted by Ken Fish and Touchstone. I don't want to take too much time, but I just wanted to highlight Ken Fish and the work that he helps myself and our team do here. And so, Ken, thank you for everything that you do for us. And I'm going to pass over to you to introduce Brian.
Absolutely. Thanks, Chris, and welcome everybody. Not a whole lot to talk about in Social Security these days. Of course, I'm kidding with that comment. I think you see almost daily now there's something in the media. I've been very fortunate to have had a partnership here with Brian Doherty, who's one of the up in front Social Security experts here in the industry. I will brag a little bit on his behalf. He's now been in the financial services industry for 35 plus years. He's authored a book called Getting Paid to Wait. And also at the end of this seminar, I'm sure that Brian is going to make mention of an opportunity to meet with Chris and team where we can run, if you're interested, your personal situation in terms of an analysis that would be customized, because not one size fits all. But just a little background aside from Brian's experience, he is the president of PhilTech, his own company. So as I mentioned before, specialization in Social Security. I would say without further ado, I'll go ahead and I'll welcome Brian and his comments, and we'll take you through a few slides. And then, of course, if there's some questions, Chris, if it's okay with you, maybe we'll wait to the end of the presentation. Or if people would like to, if they have a chat box or something, they'd like to submit it that way, you can feel more than welcome to as well. But
Yes.
Brian, I'll let you go ahead and jump on in.
Thanks, Ken, and thanks, Chris, for having both of us, and thanks everybody for tuning in. Um, I intend to make it worth your while to take some time and listen to this and watch this presentation. I've been doing this exclusively for 15 years. I've been in the financial service business for 35, but the last 15 devoted exclusively to talking about Social Security. And this presentation I've been given for 15 years, some variation of it. But a lot of people, I've done some really big meetings, like 5, 6, 700, usually financial advisors, but I do a lot of meetings for clients and individuals. But in some of these big financial advisor meetings, there's a few advisors in the audience that did know a lot about Social Security. Now, there's not many, because I find that a lot of people, most people, don't know too much about Social Security. It's an overwhelming topic. Like there's over 50,000 pages on their website. They got 2,800 rules and regulations. People get overwhelmed by it. But there are a few people, a few financial advisors especially, that know a lot about Social Security. Chris is one of them. But they always make a point to come up to me after I give my presentation and say, Brian, where'd you get your stuff? And, I thought I knew my stuff about Social Security. I've been on the website. I've done a lot of research. I've read a lot of books. I've been to other seminars and webinars by Social Security experts, and nobody talks about the stuff you talk about. Why don't they? Because some of it's really amazing. I'm like, I don't know, but now you know. Make sure you go back and talk to all your clients and actually everybody family, friends, work associates, because everybody should know the stuff about Social Security before they claim their benefits. So let's get into this. All right. So it I used to do a lot of training of financial advisors like Chris on retirement income planning. This is back in 2007, 2008. And I quickly realized that the client's Social Security decision, your decision when to claim, is going to be one of your most important retirement decisions. And basically, you want to get it right. You want to make sure you're aware of all your claimant options. Don't leave any money on the table in terms of lost benefits, because once you make that decision, basically, you're going to have to live with it for the rest of your life. So you want to make sure you make the right decision. And hopefully today we can help you do that. Now, I'm going to share with you some really compelling reasons why you should consider delaying the claiming of your benefits. Now, I'm not saying you got to wait until age 70 to claim, to get the benefits of delaying. You can delay for 2, 3, 4, 5 years and still dramatically increase your benefit amount. And when I get done, some people still might think, hey, all Brian wants us to do is wait till age 70. That's not it. In addition to doing all these seminar and webinar presentations, and I've done over 1,000 of them. I've presented to well over 100,000 people in the last 15 years. A lot of people might think that, hey, Brian just wants us to delay until age 70. No, And what I've found, and I've also done over 2,600 meetings with financial advisors and their clients one-on-one, helping the client and make the best Social Security claiming decision for their personal situation. What I found is that a lot of people go into these meetings and they're really not aware of all their claiming options. And as a result, they probably leave a lot of money on the table in terms of lost benefits. And it really adds up over time because you could live for 20, 30 years in retirement. And if you shortchange yourself by what, $3,000, $4,000 a year, that really adds up. And a lot of people do that. So I'm going to share with you 4 or 5 things about Social Security I think everybody should know. And when I get done, if you still decide to claim at 62 or 63, that's fine. That's your own personal decision, but it won't be an uninformed decision. So let's get into this. One of the reasons why you should consider delaying this is one you're probably somewhat aware of, and that is the longer you delay past age 62, the bigger your benefit is going to be. But what I found is that most people aren't aware of exactly how much their benefit is going to grow. Now, you're probably aware you can claim your benefit as early as age 62, but if you do that, you're going to lock into the smallest monthly benefit every month for the rest of your life. Now, there's some math geniuses out there that crunch the numbers and put out these white papers, these research papers of what the best age to claim your Social Security. The majority of those math geniuses will tell you that claiming at 62 may not be the best decision to make. Or you could claim it as late as age 70, lock into the biggest monthly benefit every month for the rest of your life. And the majority of those math geniuses will tell you that might be a better decision to make. Or you can claim at any age in between 62 or 70. But here's the bottom line. For every year that you delay claiming your benefit past age 62, your benefit is guaranteed to increase by 6 to 8% per year, all the way up until age 70. Now, I call that a risk-free guaranteed rate of return. And this still pretty low interest rate environment, where are you going to find a risk-free guaranteed rate of return of 6 to 8% per year? Nowhere that I know of. This is really one of the best deals around. And you know what? It gets even better. You may be aware, or you're going to become aware, that Social Security also has one of the best inflation hedges around. It's called the cost of living adjustment feature, or COLA for short. Now, a lot of people think, if they delay claiming past age 62, if there are COLA increases usually every year, but they won't benefit from them because they haven't claimed their benefit yet. And that is wrong. You will, even if you delay past age 62, you'll benefit from any of those COLA increases. So for every year you delay past 62, you get a guaranteed minimum increase of 6 to 8% per year, but you also get any COLA increases on top of it. Let me give you a real quick example. Let me take you back to December of 2021. And let's say you're 62 years old and you tell Chris, hey, Chris, I really like my job. I'm going to work for at least one more year from age 62 to age 63. Well, and I'm going to delay Social Security to age 63. Well, with delaying that 1 year, you got a minimum guaranteed increase of 7.15%. Okay. The COLA increase in 2022 was 5.9%. You basically add those two together, you increase your benefit by a little over 13%, and you locked into that for the rest of your life. That's just delaying 1 year. Now, let's say a year goes by. Now it's December of 2022, and you tell Chris, hey, you know what? I still really like my job. I want to work for at least one more year from age 63 to age 64. By delaying that additional year, you got another minimum guaranteed increase of 6.67%. The COLA increase in 2023 was 8.7%. Add those two together, you increase your benefit by another 15+% just by delaying that additional year. So just by delaying 2 years from age 62 to age 64, with a little bit of compounding, you increase your benefit by over 30%, and you locked into that increased benefit for the rest of your life. That's just delaying 2 years. You can delay for 3, 4, 5, all the way up to 8 years, all the way up to age 70. And you'll get that 6 to 8% minimum guaranteed increase and any COLA increases on top of it. Now, I know I've been doing this for a long time, and some people come up to me afterwards. Yeah, that's really incredible, Brian, but I can't wait till age 70 to claim my benefits. I'm like, well, that's fine. You don't have to. But if you can delay for just 2, 3, 4, 5 years, your benefit is going to be so much bigger compared to claiming it at age 62, and you're going to lock into that bigger benefit for the rest of your life. It's one of the best deals around. It really is. All right, so let's take a look at this is just a bar chart. These are monthly Social Security benefit amounts. It shows you how every year you delay, your benefit goes up, and we haven't adjusted them for COLA or for inflation. All right. Let's take a look at some of the other reasons why you might want to consider delaying. One is longevity. I'm going to share with you the true definition of life expectancy. I think I'm going to surprise you with it, and it's good news. How to maximize the dollar benefit of COLA. I just been talking about COLA. I'm going to show you how to get the biggest pay raise in your Social Security benefit payments every year for the rest of your life. A lot of people lock into the smallest pay raise or benefit increase. I'm going to show you how to get the biggest one. How to maximize the survivor benefit. Why every married couple and divorced spouse should know how the survivor benefit works, especially if you're a married or divorced woman. And I'll share with you why in a minute. And then real quick, I'm going to take you back to my retirement income planning days and show you how making a better Social Security claiming decision can increase the longevity of your assets and savings, make them last a lot longer in retirement, hopefully as long as you live, if not longer than that, so you can leave money to your kids, grandkids, or favorite charity. All right. Let's talk about this term life expectancy. This is a term we've heard all our lives, right? We think we know what it means. I can almost guarantee you don't know the complete definition. Now you're going to find out what the complete definition is. So life expectancy, if we put men and women together in this country, they have a life expectancy of age 78. Now, I think the majority of people in this country think, well, life expectancy is age 78, so most people die by age 78. No, that's not it. Life expectancy is simply a statistical term. And it's a mean average. And what it means is, yeah, 50% of people are going to die before age 78, but 50% of people are going to live up to and beyond age 78. And I tell financial advisors like Chris and their clients all over the country, if you're doing any kind of retirement income planning and you have a 50% probability of living up to and beyond age 78, you should plan on that happening because that's a very high probability, right? But that's only one aspect of life expectancy. There's a second aspect to it that hardly anybody knows, and that's this. The longer you live, the farther out you push your life expectancy. Now, I have a chart here. On the horizontal axis, I have ages from age 65 all the way up to age 105. On the vertical axis, I have the probability of living to those ages. All right. So if a man lives to age 65, we go up to the 50% probability, which is the definition of life expectancy. If a man lives to age 65, he pushes his life expectancy out to age 84. If a woman lives to age 65, she pushes her life expectancy out to age 86. And there's a 50% probability that at least one of them will live to age 90. Now, for all the guys, myself, Chris, and Ken, got some bad news for you. If anybody's going to live to be age 90, it ain't going to be you. It's going to be all the women on the call. Women overwhelmingly outlive men. It isn't even close. In fact, today, currently, if you look at the number of men and women alive at age 85, there are twice as many women alive at age 85 than there are men. There are 3 times as many women alive in their 90s than there are men. And if I take you back to the 2010 census, there were 53,000 people in this country aged 100 or older. 44,000 of them were women. Women live longer than men. Social Security is a bigger issue for them. Because they receive their benefit payments for a longer period of time than us men do because they live longer than we do. All right. Keep that in mind when I talk about the survivor benefit. Now, I'm not trying to convince anybody that you're going to live to be age 90, 95, or 100. All right. But most people underestimate their life expectancy by about 5 years. They think they're only going to live to be like age 80. If I can move that needle out to the mid 80s, convince you that you have a high probability of living into the mid 80s or maybe beyond that, I think I put you in a better position to make a better Social Security claiming decision. And maybe you'll seriously think about delaying claiming your benefits for a couple more years because you're probably going to receive that bigger benefit for a longer period of time than you think because you're probably going to live longer than you think. And one other thing, there's been a lot of research done on longevity and life expectancy. And people that transition into retirement with accumulated assets and savings, like you, they live longer than anybody else. Yeah, it's good news. In fact, their life expectancy is generally pushed out into their late 80s or early 90s. So you're probably going to live longer than you think, and you should give that serious consideration when you decide when to claim your Social Security. All right. Let's talk about this cost of living adjustment feature. I call this the best inflation hedge around, the best inflation hedge on the street. And the fact that our government, when I first found out that our government gives this to everybody for free, I was blown away. It's one of our government's greatest gifts. It really is. And for most people, it's going to be the only pay raise you get in retirement. If it's the only pay raise you get, obviously you want it to be as big as possible, right? A lot of people, well, some people lock into the smallest pay raise. I'm going to show you how to change that and get the biggest pay raise. Now, this is a very simple but powerful concept. So we're just going to look at this top chart here, all right? These are monthly Social Security benefit amounts. So we're going to look if somebody claims at age 62, they go to their Social Security benefit statement, says, we, Social Security, if you wait till 62, we're going to pay you $1,875 a month. Now, if that same person, instead of claiming at 62, were to wait and claim at age 70, they go to their Social Security benefit statement, says, well, if you wait till 70, we're going to increase your benefit to $3,300 a month. Now, you look at the difference between these two amounts. It starts off at $1,425 a month. They make $1,425 more a month if they waited until age 70 to claim, as opposed to claiming at age 62. All right, now this column here on the far right, I'm going to take you out 20 years into the future. I assumed an annual COLA increase of 3%. Why 3%? Well, 3% is a 75-year average for inflation. That's why it shows 3%. So with just an annual COLA increase of 3%, this 1875, 20 years later with that annual COLA increase of 3%, that grows to $3,386 a month. This $3,300 a month, 20 years later with an annual COLA increase of 3%, that grows to $5,959 a month. And look at this. Now the annual difference between these two amounts has grown to $2,573 a month. Remember, when they first started, the difference was only $1,425 a month. Now it's $2,573 a month. All right. Everybody gets the same COLA percentage increase. But if you apply that same percentage to a bigger benefit, it results in bigger dollar increases every year for the rest of your life. If I were to take this column out 25 or 30 years, because some people do live that long in retirement, especially if you're a woman, that difference would grow bigger and bigger. So how do you get the biggest pay raise every year in your Social Security for the rest of your life? Delay claiming your benefits as long as possible, ideally till age 70. You want to get the smallest pay raise every year for the rest of your life? Claim your benefits as early as possible at age 62, and you'll be applying that COLA percentage to the smallest benefit possible and you get the smallest pay raise. And still, some people come up to me and say, Brian, now when I'm done presenting, I can't wait till age 70 to claim. I go, well, you don't have to. Even if you delay for 2, 3, 4, 5 years, your benefit is going to be a lot bigger than had you claimed at age 62. And you're still going to be applying that annual COLA percentage increase to a bigger benefit, and you'll get bigger dollar increases every year for the rest of your life compared to claiming at age 62. All right. Now, the next slide I'm going to show you is going to be worth your taking the time to attend. In fact, after this next slide, if you want to go grab some lunch or something, whatever, feel free, because this slide I'm about to show you is the one that blows everybody away. And even people that knew a lot about Social Security had never seen or heard what I'm about to show you, and they think it's pretty incredible. And some of them were even dumbfounded. So let me take you, I wrote a book, Ken told you about it, about Social Security. It won a couple of awards, won the International Book Award as the best business personal finance book that year. Over 1,000 entries from 15 different countries. My book beat them all, finished #1. It also won the Eric Hoffer Award as one of the best business personal finance books that year. Well, right before I was having it published, I got charts in there like this and, math stuff. And I had some really smart math people check my math and make sure everything was correct. And a couple of them came back and said, hey, Brian, we understand your concept about applying that same COLA percentage to a bigger benefit, get bigger dollar increases every year, but you have a major flaw in that analysis. I said, I do. What is it? So they took me back to this chart here. They said, hey, look, well, here you have this person claim at age 62, right? Now you take them out 20 years into the future. If you add 20 years to age 62, that brings you to age 82. Now, instead of them claiming at 62, you look at them waiting till age 70 to claim. You also take them out 20 years into the future. If you add 20 years to age 70, that brings you to age 90. Brian, you're not comparing apples to apples. And if you did, you'd have to look at what this amount, 59.59, would be at age 82, not age 90. That it's going to be a lot smaller than 59.59. The difference is going to be a lot smaller, and you're actually going to make the case stronger for claiming early. Now, on the face of it, it seems like a really valid point, but it's not a valid point because of the incredible way that Social Security credits COLA if you delay claiming your benefits past age 62. In fact, ladies and gentlemen, when I first read about this on the Social Security website, I was like, wait a minute, I can't be reading this right. Nobody could do this. So I reread this section 5, 6, 7 times. I finally realized I was reading it correctly. And I also realized that only the federal government can do what I'm about to show you. Nobody else could do this and stay in business that long. So here's how it works. Now, over the years, I've done a number of short videos, 3 to 5 minutes on different Social Security topics. I did one, I don't know, 3 or 4 years ago. It's my most popular video by a factor of 30 times more people watched it than any other one I did. And the title of that video was, or actually is, because it's still up on YouTube, Your Social Security benefit statements are wrong. They are absolutely wrong. But you know what? They're wrong in a good way because your actual benefits are going to be substantially bigger than the benefit amounts that appear on your statement. Let me show you how this works. So here we're going to go up to this little chart up here. We're going to say this is representative of your Social Security benefit statement. We're only going to look at 3 benefit amounts. Everything plays off of your full retirement age benefit. We assume this person has a full retirement age of 66. They go to their Social Security benefit statement and it says to them, Social Security says, well, if you wait till age 66, we're going to pay you $2,500 a month. Now, the smallest benefit they could get if they claim at age 62 on their statement says, well, if you claim at age 62, we're going to reduce your benefit to $1,875 a month. The biggest benefit they can get if they wait till age 70, it says, well, on their benefit statement, if you wait till 70, we're going to increase your benefit to $3,300 a month. All right. Now we're going to come down here to this bigger chart. Column A, I show you, I got the claiming ages between 62 and 70. Column B, I show you what happens if they do claim at age 62. They start off at $1,875 a month, and it goes up a little bit every year because of the annual COLA increase. Now, check this out. If this person actually waits to age 66, they're not going to get $2,500 a month. They're going to get $2,813 a month. Why? Because if they claim at age 66, now remember, they're age 66, right? But they're going to take this $2,500, Social Security is, they're going to go back in time to when they were 62. They're going to see what the COLA increase was for that year when they were age 62. They're going to take that percentage. They're going to apply it to the $2,500. That's going to make that $2,500 amount bigger. Now they're going to take that bigger benefit. They're going to go back in time again to when they were 63. They're going to see what the COLA percentage increase was for that year. They're going to apply that to that new bigger benefit. It's going to make it even bigger. They're going to do that for 4 years in a row. So if they claim at age 66, they don't get $2,500 a month. They get $2,813 a month. Why? Because they end up getting 4 years of what I call retroactive COLA credits. Now, ladies and gentlemen, the story gets even better. It gets a lot better if they wait until age 70. If they wait till age 70, they're not going to get $3,300 a month. They're going to get $4,180 a month. Why? Because they get 8 years of retroactive COLA credits. That's incredible. Nobody knows this. Well, I can't say nobody knows it. I've showed it to well over 100,000 people, and now I've shown it to you. But everybody's always blown away. Even the people that knew a lot about Social Security. They come to, Brian, where'd you find this? I go, it's right on the Social Security website. Now you got to look real hard. It's only like 2 paragraphs on the website. There's over 50,000 pages on that website, but it's there. And this is absolutely the way it works. Your actual benefit amounts on your benefit statement are wrong. They're too low. Your actual benefits, if you claim after age 62, are going to be bigger, probably substantially bigger than the benefit amounts that appear in your statement. All right. Now, real quick, I want to go back here. Remember how those smart people said, hey, Brian, you're not comparing apples to apples. You have to look at this 59.59 amount would be at age 82, not age 90. Well, this is the age 82 amount. You know why? Because if they wait till age 70, that includes 8 years of retroactive COLA credits going all the way back to age 62. So you got the 8 years of retroactive COLA credits, and then you got the 12 years going up to age 82. So this 59.59 is their age 82 benefit. And I was comparing apples to apples. And, with retroactive COLA credits, it makes the case so much stronger for claiming early. And again, some people say to me, Brian, I can't wait till age 70. I said, you don't have to. But, every year you delay past age 62, your benefit is going to be bigger. probably substantially bigger because of retroactive COLA credits. All right. Now, one other thing I want to make with this, and this is the second most frequently asked question I get over the last 15 years. The first one is like, hey, Brian, how much longer is Social Security going to be around? Because this isn't going broke. But the second one is, Brian, what's the break-even age? And, I get this question all the time. And just based on my experience doing live presentations, that most of the people that ask me this question are guys, because guys think, hey, we're really smart in math, right? So they ask me, all right, Brian, if I wait till age 66, yeah, the benefit's bigger, but I could have claimed 4 years earlier at age 62. And I would have got 4 years of income. The benefit's smaller, but I would have got 4 years of income before I even claimed at 66 if I waited till age 66. So the benefit I receive is bigger, but how long would it take to make up for those 4 years of income I didn't receive? That's the break-even age, right? So I've learned that most the guys that ask me this question have already done the calculation. I say, what did you calculate? They say, oh, 12 years, because it takes 12 years, to break even if you wait till age 66 as opposed to claiming at 62. So you add 12 years to age 66, age 78. That's the break even age. So then I ask them, I say, well, let me ask you a question. Did you use the benefit amounts on your Social Security benefit statement? Every one of them says yes. I said, well, now you know those benefit amounts are too low. And as a result of using those too low benefit amounts, you calculated a break-even age that was too high. And if you include retroactive COLA credits, you can bring that break-even age down anywhere from 2 to 4 years. If you're using the break-even age to help you make your claiming decision, you should try to calculate it correctly. I've gotten that question hundreds of times, and everybody calculated the break-even age wrong because they use the benefit amounts on their Social Security benefit statement. All right. Let me see what I'm doing with time here. Okay. So I want to talk about the survivor benefit because, every married couple and divorced spouses that are qualified to get a survivor benefit should know how it works. Now, I've done over 2,600 meetings, Zoom meetings, one-on-one with financial advisors like Chris and his clients over the last 15 years. Probably 75 to 80% of those meetings are with married couples. Here's what I tell every married couple at the beginning of the meeting. Whoever has the bigger benefit of the two, that's the more important benefit of the two. And if you're going to delay a benefit, you should delay that benefit, the bigger benefit, as long as possible for two reasons. One, you can both enjoy that bigger benefit while you're both alive. And two, that benefit is eventually going to become the survivor benefit, or the only benefit the surviving spouse will receive after the first spouse dies. Once the first spouse dies, the smaller benefit is going to stop. You're never going to get it again. You're only going to get the bigger benefit every month for the rest of your life. So whoever has the bigger benefit of a married couple, that benefit is eventually going to become the survivor benefit. And the longer you delay it, you increase the size of that survivor benefit. So I'm going to give you a quick example here. We're going to assume the wife has a full retirement age benefit of $1,900 a month. The husband has a full retirement age benefit of $2,500 a month. Now, the only reason I gave the husband a bigger benefit is because 75% of the time today, the husband has the bigger benefit. So I usually recommend that he delay it as long as possible. But if the wife had the bigger benefit, I would recommend she delay claiming that one as long as possible. Let me quickly show you how this works. Same benefit amounts, okay? Now over here, we're just looking at the husband's claiming ages from 62, 66, and 70. All right. So check this out. The wife's monthly check or benefit at age 82 is $2,573 a month. Irregardless of the age in which the husband claimed, it's the same. Why is that? Well, believe it or not, in this situation, I had the wife claim her benefit at age 62. Now, why would I do that? I just gave you all these incredible reasons why you might want to consider delaying as long as you can, even all the way up to age 70. Why would I have the wife claim at 62? Well, those math geniuses, really smart people that put out those white papers, talk about the best age for people to claim their benefits. They'll tell you, and this makes sense to me, that whoever has the smaller benefit should probably claim it early, even as early as age 62. Why? Because that's the benefit you're going to receive for the shortest period of time. Because once the first spouse dies, that benefit goes away or stops. So if you delay claiming it, you're going to shorten that period of time even more that you receive it. So claim it early, even as early as age 62, which is what I did. And 20 years later, because of that annual COLA increase, her monthly benefit has grown to $2,573 a month. Okay, now if the husband had also claimed at 62, 20 years later, we assume they're the same age, his benefit has grown to $3,386 a month. We add these two monthly benefits together, their combined monthly Social Security income is $5,959 a month. If you were to annualize that, because this is only a monthly benefit payment, you multiply it by 12, that's paying them almost $72,000 a year with Social Security income. That's pretty good. But check this out. We assume the husband dies at age 82. The wife's benefit check stops. Now she's only going to get $37.25 a month, which is going to pay her $44,700 for the year. Remember, when they're both alive with both these checks, they were getting almost $72,000 a year. Husband dies. Now the wife's only getting $44,700. That's a drop of almost $30,000 a year. That's significant. Now, if the husband had waited till age 66, the one survivor benefit, $4,515, would have paid her $54,180 for the year. But better yet, best yet, if he had waited till age 70, the one survivor benefit check, $59.59, would have paid her $71,508 for the year. Obviously, easier to live on the $71,000 as opposed to the $44,000 or even the $54,000. That's how the survivor benefit works. Now, I'm going to show you one more chart. This is something you won't see anywhere else because I stumbled upon this myself many years ago, just crunching some numbers. So this is the same chart as the last slide. The only difference is I eliminated the age 66 line where the husband claims at 66, which we assume is his full retirement age. So all we're going to do is we're going to compare both the husband and wife claim at age 62 to just the husband who has the bigger benefit if he were to wait till age 70 to claim. So if they both claim at 62, at age 82, the husband's getting 33.86 because of the annual COLA increases. The wife's getting 25.73. We add these two checks together. The combined total of those two checks is 59.59 a month. So, but if just the husband had waited, because he has the bigger benefit till age 70, this is the one survivor benefit check, 59.59 a month. This one survivor benefit check is as big as these two checks combined, had they both claimed at age 62. That's how you leave a survivor benefit that is as big as two checks in one, greatly reducing the probability that the surviving spouse, which is overwhelmingly the wife, is going to struggle financially after the first spouse dies. Now, before we go on, real quick, I just want to leave you with a statistic from the Social Security website that when I first read about it, I said that it's almost unbelievable. So on the Social Security website, they'll tell you they send out about 70 million benefit checks every month. Of those 70 million benefit checks they send out, 4 to 5 million of them are survivor benefit checks. They'll tell you right on the Social Security website, of those 4 to 5 million survivor benefit checks they send out every month, 95% of them are sent to women. 95%. That's an incredible statistic. That backs up my claim that women overwhelmingly outlive men. And when I sit down with a married couple or a divorced spouse, I make sure they know about the survivor benefit, because chances are, I tell every married woman and divorced woman who's still qualified to get a survivor benefit that at some point in your life, that survivor benefit is probably going to play an important role, maybe even a critically important role in you maintaining your quality of life and standard of living after your husband dies, because the probability that he will predecease you is incredibly high. All right. Coming down to the end here, I just want to go through this real quick, show you, you've worked all your life saving these, you have these assets and savings, and you want them to last as long as you live, if not longer. So I'm going to show you how making a better Social Security claiming decision can do exactly that. So here, same benefit amounts for the wife and the husband. We're going to contrast claiming as early as possible, where they both claim at 62, to a strategy I like called claim early, claim late. Or whoever has a smaller benefit claims at 62. Whoever has the bigger benefit waits until age 70. Now, they have an annual income need at age 70 of $100,000 a year. Pay all the bills, enjoy life. Now, don't get hung up on the $100,000. If your income need is only 50, 60, 70, 80, maybe it's 120 or $150,000, the concept still works. All right. So if they both claimed at age 62, at age 70, Social Security, because of the annual COLA increase, is going to pay them $50,160 a year. Now, if they use my claim early, claim late strategy, we're going to increase their Social Security income to $71,820 a year. That's an increase of almost 50%. Now, Chris knows that your biggest challenge or risk in retirement is longevity risk, the risk of living too long. Now, I've done a lot of these meetings with, married couples and divorced spouses and widows, widowers, and single people. And they think the biggest risk is dying young. I die young. I mean, so I should claim early, that kind of stuff. But now I talk about this strictly from a financial standpoint, and please don't be offended with what I'm about to say. But I tell them dying young is not the problem. Dying young solves all the problems because when you're dead, you stop spending money. Living a long life is the biggest challenge in retirement because the longer you live, the harder it becomes to maintain your quality of life and standard of living for a number of reasons. So, longevity risk is the biggest risk. Can you get longevity insurance? Yes, you can. You know what the best kind is? Guaranteed lifetime income. That's exactly what your Social Security income is. You're going to get it to the day you die. So, and you should take a lot of comfort in that. And I tell financial advisors and their clients all over the country, look, if you can outlive your assets and savings, but you cannot outlive your Social Security income, you're going to get it to the day you die. So by increasing their Social Security income by almost 50%, we got them 50% more longevity insurance, reducing the biggest risk in retirement, longevity risk. One of the second biggest risks is the withdrawal rate risk. Look at, I've traveled all over the country, just about every state. The only state I haven't been to is New Mexico. I'm going to get there before I die, just to say I've been to all 50 states. But I work with hundreds of advisors. Well, I've talked to thousands of them, and some of them come up and say, "Hey, Brian, I got clients that retire with $1 or $2 million, and they think they're millionaires. Well, basically, they are. They have, $1 million, $2 million, but they think it's going to last forever. Then they go a little crazy. They buy vacation homes either in Florida, Arizona. They they buy homes for their kids. They take these great vacations. They buy these incredible cars, and before you know it, 6 or 7 years later, they're down to $600,000 or $700,000. They look at the financial advisor and say, "What did you do to me?" And the financial advisor, like Chris says, "I didn't do anything. In fact, the market's been incredible for the last 10 years. You've just been spending too much money." So they need $100,000 here. If they both claim at 62, at age 70, Social Security's providing them with $50,160. That means they have to withdraw $49,840 from their accumulated assets and savings to meet their income need of $100,000. But over here, we increased their Social Security income to almost $72,000. Now they only have to withdraw $28,000 to meet their income need of $100,000. Look at you. I'm not a math major. You don't have to be to realize that if you're only withdrawing $28,000 a year, as opposed to $50,000 a year from your assets and savings, your assets and savings over here with the claim early, claim late strategy are going to last a lot longer in retirement. Making a better Social Security claiming decision, we also greatly reduce withdrawal rate risk. One of the last biggest risks is inflation. And I told you, Social Security has the best inflation hedge around, COLA. So here they need 100,000. Social Security provides a little over 50. So 50% of the income need is automatically going to adjust to inflation. But over here, we increase their Social Security income to almost 72,000. That means 72% of their income need is automatically going to adjust to inflation. So we put them in a much better position to keep up with inflation. So real quick, just by making a better Social Security claiming decision, we greatly reduce longevity risk, withdrawal rate risk, and inflation risk. And we put this person, which could be you, in a much better position to be more financially comfortable and less stressed out about money in retirement. Who doesn't want that? All right. Last thing, and I'm done. I just want to talk to you about this spousal benefit, which is an incredible feature for Social Security. Now, it may not apply to everybody, but if it does apply, it's an incredible feature. One spouse is entitled to 50% of the other spouse's work history benefit at full retirement age. Let me give you a quick example of how this works. We got Chris's benefit at 2,000. Chris and Lee are married. Let's say they're the same age. Lee's benefit's only $500. Let's say they have a full retirement age of 66. They both decide to work to 66, retire, and claim Social Security. Chris retires, he gets his $2,000 a month. But Lee, because Lee's subjected or is entitled to a spousal benefit, she gets $1,000 a month. If she wasn't entitled to the spousal benefit, she only get $500 a month. But because she gets $1,000 a month and doubles her Social Security income. That's pretty cool. Now, check this out. This is something hardly anybody knows. Let's say I'm talking to Chris and I say, "Hey, Chris, try to wait till at least 66 to claim your benefits." He's like, Brian, I've been working for 40, 45 years. I paid all those FICA taxes, those that are taxes that they take out of your paycheck to fund Social Security. I've paid hundreds of thousands of dollars in FICA taxes. I'm not taking the chance of waiting until age 66. What if I die at age 64 and I never got a chance to claim my benefits and I end up with nothing? I ain't taking the chance. I'm claiming as early as possible at age 62. I don't care if they decrease my benefit, which they do. Instead of Chris getting $2,000 a month, he only gets $1,500 a month. All right. Lee says to Chris, hey, Chris, I don't care if you retire at 62. I still like my job. I want to work till 66, retire and claim Social Security, which she does. And check this out. She still gets $1,000 a month. You would think because Chris claimed his benefit early is reduced to 1,500, 50% of that is only $750. And that would be the amount of the spousal benefit that we would get, $750. It doesn't matter that Chris claimed his benefit early. It has no impact on the size of the spousal benefit Lee will get. As long as Lee waits till her full retirement age, she's still entitled to 50% of Chris's full retirement age benefit, that's $2,000. So she still doubles her Social Security income. Now, I need to add one more slide. Let's say Chris decides to work to age 70. He does, and he claims his benefit. His benefit, because he waited till 70, would be increased to a little over $2,600. Now, even if Lee waits to her full retirement age or after that, she's not going to get half of the $2,600, $1,300. She's still going to get half of the $2,000 or $1,000 a month. But it's still a really good deal because she still doubles her income. All right. So that's it. I want to add one last thing here, and then I'll turn it back to Chris. And I think we have a little bit of time to have some questions. But Ken told you about, I've created a Social Security calculator. I call it my Claim with Confidence Social Security calculator. I've created this over the last 12 to 15 years. We continue to make enhancements to it. But I told you I have 2,600 meetings with financial advisors, Zoom meetings. The basis of the meeting is the output from our calculator. It'll show you all the benefits you're entitled to and make sure you get every dollar of benefit that you are entitled to. And I highly recommend that you take advantage of this because at least have the analysis done. You may think it's pretty straightforward, but you should make sure you know what all your claiming options are. My calculator will make sure you are aware of it. You get every dollar of benefit you're entitled to. Now, the last thing that you want to do is go to Social Security itself and ask them, what you should do. Now, technically, they're not supposed to give you advice, but sometimes they do. But that's a really bad plan because unfortunately, Social Security customer service employees give out incorrect and wrong information all the time. It's a big issue. Now, it's happened to me a number of times, but that's only anecdotally, right? How big a problem is it? Well, we got some concrete evidence, and it comes right from Social Security itself. Because about 4 or 5 years ago, they published the results of an internal audit they did on their own customer service employees. And what they found, now keep in mind, 70 million people get a benefit check every month. They only took a sample size of 13,000 cases. They looked at 13,000 cases, and what they concluded was on over 11,000 of those 13,000 cases, or over 80% of them, their customer service employees gave out incomplete or wrong information, and it cost those 11,000 plus people a cumulative total of $142 million in lost benefits. That's bad enough. But you know what's even worse? They reported these results 4 or 5 years ago. They haven't done anything to correct their mistake. They haven't done anything to make these people whole. And they just kind of say, yeah, our customer service employees gave out incomplete information, wrong information. It cost them 142 million. They're just going to have to live with it, though. That ain't right. So I would take advantage of a free analysis. And if you want to get on the phone with Chris and myself, and we'll go through the analysis, it'll only show you a maximum of 3 potential strategies for your personal situation. We'll get on the phone and we'll help you pick the best strategy for your personal situation. I highly recommend that you take advantage of it. We'll make sure you get every dollar of benefit that you're entitled to. So with that, Chris,
thank you.
Yeah.
Thank you, Brian. Can you speak to a lot of Americans hear the buzz in the media about Social Security going broke and the reserve fund and benefits? Can you speak to that
Oh, yeah. Well, like I said, that's the most frequently asked question I've gotten over the years. And I think well over 90% of people in this country think that Social Security is going broke and eventually they're going to stop making benefit payments. I don't think that'll ever happen. So there's a major misperception about Social Security going broke. And what they hear, they're going to go broke in 2033 or 2034. Well, Chris, there is a long-term funding issue that has to be addressed. Excuse me, the math to address it is not that complicated. But let me give you an example of what happened the last time they had to address a long-term funding issue. They did it in 1983, and Alan Greenspan was the chairman of the committee that fixed Social Security. And what they did was then they increased FICA taxes, right? They increased the taxes, but they increased them high enough that they knew they were going to take in more money from those taxes than they had to pay out in benefits for about 30 years. So every year there was going to be a surplus, right? They'd have more money because they took in extra money than they had to pay out in benefits. And they set up the surplus account. There was $2.7 trillion in that account. Now there's about $2.5 trillion. But what they knew that 30 years down the road, when baby boomers really started to retire, there'd come a time where they'd taken less money from the FICA taxes than they had to pay out in benefits. And so in order to make full benefit payments, they'd have to dip into that surplus account, which they have been doing for a number of years. And what the Social Security trustees say, if the politicians don't do anything to address the long-term funding issue, then in the year 2033, that surplus account will be gone. There won't be any money in the account, and they'd have to reduce benefits by about 22%, right? So everybody would get 78 to 80% of what they were getting. Now, a lot of people interpret that surplus account to be gone in 2033, meaning Social Security is totally broke. They have no money. They're going to have to stop making benefit payments. No, Social Security will never go totally broke. Those FICA taxes that they take in every month, they take in over $100 billion a month, over $1 trillion a year. Social Security will never go broke. But if they don't address the long-term funding issue in the year 2033, whatever, they have to reduce benefits by about 20%. And if they have to do that, Chris, and I don't think they will, then they're on sound financial footing and can meet all their benefit obligations through the year 2098, almost into the next century. That's the worst thing that can happen. Now, believe me, I think that when push comes to shove, they'll get around to fixing the system because 70 million people get a benefit check every month. And of those 70 million, probably about 25 million of them, that's all they got. They got nothing else. That's their only source of income in retirement. If Social Security would go broke and stop making benefit payments, they'd push 25 million people not only into the ranks of poverty, but they'd probably be homeless and destitute. It isn't going to happen. And when push comes to shove, I think they'll get around to fixing the system. And you know what? There may be some benefit cuts. That's what they did in 83. They did institute some benefit cuts, but they implemented them over 20 or 30 years. And the people that were already, I don't know, 55 or 60, they were grandfathered. They weren't affected by that. I fully expect, although I can't say with 100% certainty, that if they do make some benefit cuts, I'm over the age of 60. I fully expect I'll be grandfathered. Maybe some of your clients or people on the call are over 55 or 60. I fully expect that they be grandfathered too, and we wouldn't be affected by it. Now, Chris, you look like a pretty young man. You may be affected by it, but we won't. And I got to tell you, I'm not going to feel sorry for you either, man. But anyway, I think because you think Social Security is going broke, that's a good reason to claim early. No, it isn't, because I don't think it's ever going to happen that well, for sure, they're not going to stop making benefit payments. Too many people are critically dependent on it.
That's great. That's very helpful information because I think a lot of people look at that surplus, right? And when they hear going broke, I mean, that is the piece that's running out. But like you said, there's the FICA revenue that everyone sees on their pay stub, right? That's going in, and there's $100 billion going into the system. Now, a lot of it does go out, obviously, but you're still paying the tax on it. So a lot of solutions, right? That could potentially could be pushing it back from 67 perhaps to 68, the full retirement age, right? You could raise the FICA tax. Or you could reduce benefits to some degree. So there's a few things happen. But I think the most important thing that I heard was that, if you're 63 now, right, and you get to 67 and you say, I'm going to claim, and then there's a reduction of 20%, 3 years after you claim, you're fine. You're covered. You're not going to have any reduction.
Yeah, I mean, again, that's what they did in 83. I fully expect that would happen if they do like raise the full retirement age or, institute some benefit cuts that if you're over the age of 60, you'd be grandfathered. And again, I can't say with 100% certainty. I just go by past experience that that would happen. And one other thing I want to add about this is a huge misperception about Social Security. They think that the government borrow money to make full benefit payments. Right now the law could change, but right now it's illegal for Social Security to borrow money to make benefit payments. They can't do that, right? So anybody that says Social Security is contributing to this $37 trillion budget deficit, they're totally wrong. It hasn't contributed one dime to that budget deficit. Now, they could change the law and say it's okay for Social Security to borrow money to make benefit payments. I hope they don't do that. But right now, they're not contributing to the national debt at all. It's illegal for them to borrow money to make benefit payments.
Excellent. And then just one final piece before we close this. There was a lot of obviously new administration this year. There was the Doge that was set up, and there's been a lot of noise about when Musk was running it, and obviously them looking into Social Security. Can you maybe speak to some of that noise?
Yeah, so I mean, there's all kinds of misperceptions out there, and they put headlines in magazines and newspapers and on the internet that scare people, that Social Security is going to cut benefits. And even when Elon Musk was there, they said, we're not going to touch benefits. And, President Trump has come out a number of times to say we're not going to decrease benefits. What they did like lay off 5,000 or fire 5,000 people that work for Social Security. They went from 55,000 employees to 50,000. And that kind of made the wait time and stuff even worse than it is. But they've come out a number of times to say they have no intention of cutting benefits. And if they did, I think it would be disastrous for them in terms of their political ambition. I know President Trump is done after this term, but any congressman that voted for it, and it would have to be voted on Congress. You can't have, what are they? He signs those. I forget what they are. Executive
Yeah, the
orders.
executive orders.
Yeah, you can't decrease Social Security benefits with an executive order. It has to be voted on in Congress, and believe me, nobody in Congress is going to vote for that.
Yeah, very helpful. Very helpful. Well, Brian, thank you so much for the time, and I want to thank Ken Fish for making this happen. I think this is important to obviously have an expert like yourself, Brian, and go through this. So thank you. And that calculator, I think, is very important because you made a lot of great points about the COLA. And so most folks out there probably aren't doing the break even if they're doing it correctly, especially if you're doing it in an AI tool. I think a lot of those tools are not yet advanced to that degree. So, Brian, thank you so much. And I will stop the recording now. Thank you.
All right, Chris, thanks for having me. Thanks, everybody. Hope you found it useful.